So if the Fed cuts by 25 basis points and Jerome Powell hops on there and tells reporters things will probably be, we will continue to lower rates in the back half of the year, what happens to the markets?
Well, I think clearly the market is expecting a rate cut here, so I think that would placate the market. I think, as you mentioned here, the messaging is going to be key because the market's going to be paying attention to what's the future path of rate cuts. But, I think what the Fed is doing here is just responding to what the market wants. The market's sending a clear signal that it expects rate cuts. But let's not forget this is the same market that a little over a year ago was telling the Fed they ought to be hiking interest rates more aggressively because they were more worried about inflation. And so I think the Fed runs the risk of trying to placate the market too much. What they ought to do is, assuming that we get a rate cut today, which I'm sure we will, is be what they say they are, data dependent, look at the incoming data. And I think the incoming data really doesn't support a lot of big changes to monetary policy. I don't think these multiple cuts are needed. So I'm sure that the market will hang on every word and try and extrapolate out what monetary policy is going to be out into the future. But the fact of the matter is the economy looks pretty stable, and I'm not sure so much more accommodation is actually needed.
And we know that inflation remains a big focal point for the Fed. They have said since 2012 that 2% inflation is a signal of a healthy economy. We still can't seem to get there yet, even though we are at or near full employment. Do you think that low inflation, more than a global economic slowdown, is really what's fueling the Fed to want to cut interest rates at this point? And is it going to work? Will a quarter-point cut really help boost prices?
Well, first, I don't think the Fed should be so fixated on some specific number. I think 2% is a nice general target for them to have, but whether or not we're a little bit below that or a little bit above that, what really ought to matter is, are we starting to accelerate beyond that and the Fed needs to get ahead of that? Or are we seeing some significant deceleration here that the Fed needs to react to? And really today we're not seeing either of those. It's true that inflation isn't quite their target, but it's stable, and I think that's what's most important here. And I think the whole notion that these interest rate cuts are necessarily going to drive more inflation, I think that's just an incorrect notion. I mean, if that were the case, you'd be seeing a lot of inflation in places like Japan and Europe today, and clearly you're not. You'd be seeing stronger economies there if all of this monetary accommodation was really stimulative. And I think what you're seeing is that the Fed doesn't have all the answers to all the problems, and just doing things like quantitative easing, cutting interest rates, that's not enough to drive inflation and necessarily stimulate growth. If the Fed wants to stimulate, what they've got to figure out a way to do is get more money into the economy through bank lending that'll cause the money supply to increase more quickly. And I'm not sure that these modest interest rate moves in one direction or other really affect that.
Aaron, so to your point, do you think the Fed should just drop the hammer today and lower by 50 basis points, silence the president a little bit, and get asset prices even higher?
I don't think so, no. First off, I don't think that the Fed cutting interest rates necessarily has the impact on asset prices that people think it does. I mean, going back to those prior examples, if really low interest rates drove asset prices a lot higher, you'd be seeing a lot higher equity markets and so forth in places like Japan and Europe. You'd see much stronger economic growth there. I think a 50 basis point cut runs the risk of spooking the market a little bit. Suddenly market participants start to say, well, what is the Fed seeing that I'm not seeing? And if you look at the incoming data, as I mentioned before, it actually looks pretty good. We just got a healthy GDP report here. You look at more recent economic data and actually looks pretty good. And so certainly if you're just data dependent like the Fed says it is, and you look at not just market-based data, but you look at economic data, there's really not a big need for the Fed to do much of anything. And so if I'm a market participant, which I am, and I say to myself, well, things seem stable to me, and yet the Fed is being fairly aggressive in cutting interest rates more than we thought they would, I think that starts to raise some questions amongst investors of what's out there that the Fed is seeing that I'm not.